Welcome to Chapter 1, where we dive into cost volume profit analysis. This chapter focuses on understanding how the CVP model helps businesses make informed decisions. We'll explore how costs, sales volume, and profit interact, and see how this analysis provides key insights that guide everything from pricing to production levels. It's an essential tool for evaluating how changes in costs and sales impact a company's profitability. Chapter 1 introduces us to cost volume profit analysis, or CVP analysis for short. Essentially, CVP analysis is a financial model that helps us understand how changes in costs, sales volume, and prices can impact a company's operating income. It's a valuable tool for managers because it allows them to explore different what-if scenarios, such as determining the break-even point, setting profit targets, evaluating cost structures, and assessing the financial consequences of various business decisions. In other words, CVP analysis provides a clear framework for making informed decisions that can influence a company's profitability. Let's dive into the key components of the cost volume profit, or CVP, model. There are four main variables that shape how profits behave in this model. First, fixed costs. These are the costs that remain constant in total, at least within the relevant range of activity. They don't change no matter how many units we produce or sell. Next, variable costs, which move directly with the number of units produced or sold. They increase or decrease in direct proportion to volume. Then we have the sales price, which is simply the revenue we earn for each unit sold. Finally, volume represents the number of units sold. Understanding how these four variables interact helps us analyze and predict profit behavior effectively. Now, let's talk about cost behavior, focusing on fixed and variable costs. Fixed costs remain unchanged in total within a relevant range, no matter how much unit sales increase or decrease. For example, factory rent, salaries for supervisors, and insurance costs stay the same regardless of production levels. On the other hand, variable costs change directly in proportion to activity, but the cost per unit stays consistent. Examples include direct materials, sales commissions, and packaging costs per unit. On the production floor, volume directly affects the usage of materials and labor, but not every cost fluctuates with each unit produced. Understanding this distinction is crucial for effective cost volume profit analysis. Here we are looking at the break-even point, which is a crucial concept in cost volume profit analysis. The break-even point is where total revenue exactly equals total costs, meaning the business is not making a profit but also not incurring a loss. To calculate the break-even units, you divide the fixed costs by the contribution margin per unit. This calculation helps managers understand how many units need to be sold before the business starts making a profit. Essentially, the break-even point tells us the minimum sales volume required to cover all costs, providing a valuable benchmark for decision-making and planning. Now let's look at the break-even formula, which is essential for understanding when a business neither makes a profit nor incurs a loss. There are two ways to express this zero profit point: break-even units and break-even dollars. First, break-even units tell us how many individual units must be sold to cover all fixed costs. To calculate this, we divide the fixed costs by the contribution margin per unit, which is the amount each unit contributes toward covering those fixed costs after variable costs are deducted. On the other hand, break-even dollars give us the sales revenue needed to break even. This is found by dividing fixed costs by the contribution margin ratio, which is the contribution margin expressed as a percentage of sales. Understanding both calculations is crucial in cost volume profit analysis, helping businesses set sales targets and pricing strategies to ensure financial stability. Now, let's dive into the concept of contribution margin. The contribution margin represents the amount each unit sold contributes to covering fixed costs and, ultimately, generating operating income. You can calculate it per unit by subtracting the variable cost per unit from the sales price. Essentially, it tells us how much revenue remains from each sale after we've covered the variable costs associated with that unit. This is crucial because it forms the foundation for break-even analysis, profit planning, and making informed pricing decisions. Understanding the contribution margin helps businesses determine how many units they need to sell to cover fixed costs and start making a profit, which is central to cost-volume profit analysis. Let's take a closer look at the difference between contribution margin and gross margin. Contribution margin is calculated by subtracting all variable costs from sales revenue. This figure tells us how much money is left over from sales to cover fixed costs and then contribute to operating profit. It's especially useful for cost-volume profit analysis because it isolates the impact of variable costs. On the other hand, gross margin is sales revenue minus the cost of goods sold. This is a key metric mainly used for external financial reporting. However, unlike contribution margin, gross margin does not separate variable costs from fixed costs, so it's less helpful for making internal decisions about cost behavior or profitability based on sales volume changes. Understanding the distinction between these two margins helps us analyze different aspects of a company's financial health and make better management decisions. Now, let's delve into how cost-volume profit analysis helps us set and achieve profit goals. Essentially, CVP analysis turns a profit target into the number of units we need to sell. The big question is, how many units must we sell to hit our desired profit? The formula is straightforward. We take our fixed costs, add our target operating income, and then divide that total by the contribution margin per unit. This tells us exactly how many units we need to sell to cover costs and reach our profit goal. For example, if our fixed costs are $120,000, our target operating income is $80,000, and each unit contributes $20, then we need to sell 10,000 units. This calculation is crucial because it guides our sales targets and helps us plan effectively to meet financial objectives. Now, let's talk about how income taxes impact cost-volume profit analysis. Taxes reduce the operating income, which means that businesses need to generate higher sales to cover these taxes and still achieve their profit goals. To adjust for this, we calculate the required pre-tax income by dividing the target after-tax income by 1 minus the tax rate. It's important to note that taxes do not affect the break-even point in terms of operating income since break-even means zero pre-tax profit. However, when aiming for a specific net income target, managers must earn more profit before taxes. As a result, higher tax rates increase the amount of sales needed to reach that target income. This adjustment helps ensure that the business accounts for taxes when planning its sales and profit goals in cost-volume profit analysis. Now, let's talk about sensitivity analysis and why it's such a valuable tool for managing uncertainty. Essentially, sensitivity analysis shows us how changes in key assumptions, like selling price, sales volume, variable costs, or fixed costs, impact the overall profit. This helps us identify which factors have the biggest influence on our results, so we know where to focus our attention. It also allows managers to compare different scenarios, whether it's the best case, expected case, or worst case, giving a clearer picture of potential outcomes. By doing this, sensitivity analysis improves our planning process, especially when we're dealing with unpredictable market conditions. This approach is closely linked with cost-volume profit analysis, making it easier to understand how costs and sales volume interact to affect profitability. Overall, it's an essential technique for making more informed and confident business decisions amid uncertainty. Let's talk about scenario analysis within cost-volume profit, or CVP, analysis. This approach helps us understand how small changes in key assumptions can significantly impact profit results. For example, if the selling price increases, the contribution margin per unit goes up. This means we can break even with fewer sales, assuming demand stays steady. On the other hand, if variable costs rise, each unit contributes less to covering fixed costs, so we need to sell more units just to break even or reach our income targets. Changes in fixed costs also play a big role. If fixed costs go up, the break-even point moves higher, making it tougher to avoid losses. Conversely, if fixed costs drop, we enjoy a wider margin of safety, giving us more cushion against sales fluctuations. These what-if scenarios are invaluable for planning and making informed decisions. Cost volume profit analysis is a vital tool that managers rely on for making important business decisions. One of the key questions it helps answer is how many units need to be sold to make a new strategy viable. It also allows us to explore what might happen if there are changes in price, sales volume, or costs. This way, managers can evaluate different scenarios and risks. Ultimately, CVP analysis helps us determine which option is most likely to achieve our target profit while keeping risk at an acceptable level. It's about making informed choices that balance opportunity and caution. In this chapter, we're focusing on planning both variable and fixed costs, which is a critical part of managing a business effectively. Cost volume profit analysis, or CVP, plays a key role by helping managers shape the cost structure before any sales occur, allowing for better decision-making. When it comes to variable cost planning, the goal is to control the cost per unit. This can be achieved through smart sourcing, improving labor efficiency, and designing efficient processes. By doing this, we can raise the contribution margin, meaning each sale contributes more quickly to covering fixed costs. It's also important to test price and volume trade-offs carefully before making changes to materials or selling prices, since even small shifts in unit costs can significantly squeeze profits. On the fixed cost side, commitments like rent, equipment, salaries, and technology capacity need to be made cautiously. These higher fixed costs increase operating leverage, which also raises the break-even risk if sales don't meet expectations. That's why modeling expected sales volume is essential to determine whether investing in additional capacity will pay off. Ultimately, the best approach is to choose the right blend of fixed and variable costs that aligns with the company's strategic goals and the level of uncertainty it faces. Overall, effective planning of variable and fixed costs combined with CVP analysis helps ensure that the business remains flexible, profitable, and prepared for different scenarios. When a company sells multiple products, applying cost volume profit analysis becomes a bit more complex. The key is to use a weighted average contribution margin, which takes into account the sales mix of all products. For example, if we look at 3 products, alpha, beta, and gamma, each contributes differently to the overall margin based on their sales proportion and unit contribution margin. Alpha might make up 50% of sales with a $40 contribution margin per unit, beta 30% with $30, and gamma 20% with $20. By multiplying each product's sales mix by its contribution margin, we get the weighted contribution margin, which in this case totals $33. This overall figure is what we use for break-even analysis, meaning the break-even point depends on the expected sales mix across all products, not just one product alone. So, understanding and correctly estimating the sales mix is crucial for accurate CVP analysis in multi-product companies. Here, we're looking at the concept of sales mix and how it relates to the weighted average contribution margin, which is a key part of cost volume profit analysis. Sales mix refers to the relative proportion in which a company sells its different products. Understanding this mix helps us determine a combined measure of profitability across all products. The weighted average contribution margin, or WACM, is calculated by multiplying each product's sales mix percentage by its unit contribution margin, then summing these amounts. For example, if product A represents 60% of sales and has a contribution margin of $20 per unit, its weighted contribution is $12. Product B might make up 40% of sales with a $35 contribution margin, yielding $14 weighted. Adding these gives us a weighted average contribution margin of $26. This figure is crucial because it reflects the overall profitability per unit sold, weighted by the sales mix, and is used in cost volume profit analysis to support better decision-making and forecasting. Now let's dive into how cost volume profit analysis applies specifically to service organizations. The core logic remains the same, but the key cost drivers differ from manufacturing. Instead of focusing on units produced, service organizations look at billable hours, client visits, or engagements as their main drivers. For example, consulting firms often track utilization rates and the contribution margin generated by each project. In healthcare, providers analyze patient visits, medical procedures, and the reimbursement levels they receive. Accounting firms, meanwhile, focus on staff capacity, billing rates, and fixed overhead costs to understand profitability. So, while the principles of CVP analysis hold, the metrics and data points we use shift to fit the service context. This helps these organizations manage costs and revenues to improve financial performance. In mission-driven organizations, understanding volume, cost, and funding is just as crucial as it is in for-profit businesses. Instead of focusing on profit, these nonprofits look at surplus, the extra funds that allow them to sustain their programs and operations. Essentially, they've adapted the traditional cost-volume profit analysis to fit their unique needs by focusing on a target surplus or the funding required to keep things running. This shift changes the key questions managers ask. Instead of profit margins, they want to know how many donors, tickets, grants, or service units are needed to cover fixed costs and achieve their mission goals. It's all about aligning financial clarity with fulfilling their purpose. When we talk about the limitations of cost-volume profit analysis, there are a few important points to keep in mind. First, CVP assumes that relationships are linear, meaning costs, revenues, and volume all move in straight-line patterns. In reality, these factors can be much more complex and nonlinear. Second, CVP tends to ignore shifts in market demand. It doesn't take into account changes in customer preferences, pricing pressures, or the competitive environment, which can all impact results significantly. Third, this analysis often assumes there's just a single product or a fixed sales mix, which simplifies things but may not reflect the diversity most businesses face. Lastly, the validity of CVP is limited to the relevant range. If operations move beyond normal levels, the cost behaviors and other assumptions can break down, making the analysis less reliable. Understanding these limitations helps us use CVP more effectively and recognize when additional tools may be needed. When we talk about cost-volume profit relationships, it's crucial to understand the concept of the relevant range. This refers to the specific band of activity where certain assumptions hold true, namely, that the selling price, variable cost per unit, and total fixed costs remain constant. Within this relevant range, we can rely on CVP formulas to provide accurate insights. However, if activity falls too far below or rises above this range, these assumptions start to break down. For example, at low volumes, you might encounter idle capacity, discounts, or inefficiencies that impact costs differently. On the other hand, at high volumes, capacity limits, step-fixed costs, or changes in pricing can alter the cost behavior. Outside the relevant range, costs and revenues no longer follow the straight, predictable patterns that CVP analysis depends on, so it's important to keep this in mind when applying these concepts in real-world situations. Here, we're looking at the concept of margin of safety. Simply put, it's the difference between your expected sales and your break-even sales. This tells us how much sales can drop before the business starts operating at a loss. The formula is straightforward: margin of safety equals expected sales minus break-even sales. So, why is this important? A larger margin of safety means the business has a bigger cushion. It reduces risk by allowing the company to withstand a decline in sales without immediately facing losses. In cost-volume profit analysis, this measure is crucial because it helps managers understand how vulnerable the business is to fluctuations in sales, guiding better decision-making and planning. Here we have a real-world example of applying cost-volume profit analysis. Imagine a beverage company launching a new bottled tea line. They want to determine if this product can meet their profit objectives. Key inputs for this case include a selling price of $8 per bottle, a variable cost of $3.20 per bottle, fixed costs totaling $420,000 annually, and a target operating income of $180,000. The main questions they need to answer are: how many bottles must they sell to break even? What sales volume will achieve their target profit? And how would changes like price reductions or increased fixed costs affect these numbers? By using CVP analysis, the company can strategically evaluate these factors and make informed decisions about pricing, production, and sales targets to ensure profitability. Let's review the key takeaways from our discussion on cost volume profit analysis. First, CVP links cost, volume, and profit in a straightforward decision model, helping us understand how these elements interact. Break-even analysis is essential because it shows the minimum sales level needed to avoid losses. This is our safety baseline. The contribution margin is a critical concept. It reveals how much each sale contributes to profit after covering variable costs. Target income analysis then takes this further by working backward from our profit goals to determine the necessary sales levels. To manage uncertainty, sensitivity analysis comes into play, allowing managers to test different scenarios before committing to a plan. Finally, CVP is versatile and can be applied across various contexts, from multi-product companies to service providers and not-for-profit organizations. These 6 ideas make CVP not just theoretical, but practical, predictive, and truly decision-ready. To wrap up, mastering cost volume profit analysis gives you a strategic advantage. It empowers you to make confident, data-driven decisions across all aspects of your business, from setting prices to planning operations. By thoroughly understanding your cost structure, you can anticipate outcomes and test assumptions, allowing you to act with greater clarity and control. Ultimately, this insight provides you with greater leverage over your profit, helping your business thrive.